Let me take you back to 1929 to a place called the Florida Everglades. Thousands of Americans, ordinary working people, teachers, factory workers, small business owners, they're standing in muddy fields, clutching paper deeds to land they've never actually seen. They've been told this swampland will be the next Miami Beach. Developers are promising returns of 300, 400, even 500%. Banks are handing out loans like candy. And for a few glorious months, it actually works. People are flipping land contracts, making fortunes on paper, and everyone believes they've discovered the secret to effortless wealth. Then the hurricanes come. Not just literal storms, but the financial kind. Land values collapse, banks fail, those paper fortunes evaporate overnight. And here's the really cruel part. The developers, the ones who sold this dream, they had already cashed out months earlier. They knew exactly what was coming. By the end of this video, you're going to understand the exact mechanism that separates the people who build real, lasting wealth from those who just think they're wealthy until reality catches up. I'm going to show you precisely how investing $100,000 across the 3 best index funds actually plays out over 10, 20, and 30 years. And more importantly, I'm going to reveal why most people get this completely wrong even when they think they're doing everything right. But first, we need to understand why that Florida swampland story matters so much to what you're about to do with your money. My name is Tom, and I spend way too much time thinking about money and psychology. If you're someone who's sitting on some capital, maybe you've saved up $100,000, maybe you've inherited it, maybe you sold a business or a property, and you're trying to figure out the smartest, most efficient way to grow it without falling for the next swampland scheme, subscribe and like this video. It helps more than you think. And honestly, what we're about to discuss is the kind of stuff I wish someone had explained to me 15 years ago. Now, here's the thing about that Florida land bust. Everyone involved thought they were being smart. They weren't throwing money at random stocks or gambling in casinos. They were investing in real estate, which everyone knows is safe, right? Land. Actual physical dirt. How could that possibly go wrong? The answer, of course, is that they weren't really investing in land. They were investing in a story. A narrative about endless growth, about guaranteed returns, about how this time, somehow, the basic rules of economics didn't apply. And this is where it gets really interesting, because almost a century later, we're still making the same fundamental mistake. We just dress it up in different clothes. Let me tell you about something called the Nifty 50. This was back in the late 60s and early 70s. The biggest, most sophisticated investors on Wall Street, we're talking pension funds, insurance companies, the supposed smartest money in the room, they all became obsessed with 50 specific stocks. Companies like Xerox, Polaroid, Avon, Kodak. These were the magnificent 7 of their era. The logic was simple and seemingly bulletproof. These companies were so dominant, so well managed, so essential to modern life that you couldn't lose money buying them. The strategy became known as one-decision stocks. You buy them once, hold them forever, and watch your wealth compound into infinity. Now, why would they do this? Well, look at the numbers. In 1972, these stocks were trading at price-to-earnings ratios of 50, 60, sometimes even 90 times earnings. Polaroid hit 91 times earnings. To put that in perspective, the historical average for the stock market is around 15. These investors were paying 6 times the normal price because they believed these companies were essentially immortal. But here's the catch. They weren't buying businesses anymore. They were buying the idea of certainty in an uncertain world. They were buying comfort. And when you pay a premium for comfort, you're usually about to get very uncomfortable. Between 1973 and 1974, the stock market crashed. Not a little dip, a catastrophic collapse. The Dow Jones dropped 45%. But the Nifty 50 stocks, they got absolutely destroyed. Xerox fell 71% from its peak. Polaroid crashed 91%. Avon dropped 86%. These weren't speculative garbage companies. These were the blue chips, the safe bets. The stocks that every financial advisor said you could put your grandmother's retirement into. $45 billion in market value evaporated in roughly 18 months. That's in 1970s dollars. Adjust for inflation and you're looking at something like 300 billion in today's money. So what happened? Who won and who lost? The big institutions, they survived. They had diversification. They had time horizons measured in decades. They could wait out the storm. But the individual investors who followed their lead, the regular people who thought they were being smart by copying the smart money, they got wiped out. Many of them sold at the bottom, crystallizing losses they would never recover from. And here's the kicker. The companies themselves didn't all fail. Some of them, like IBM and Coca-Cola, eventually recovered and went on to make investors fortunes. But it took 15 years of holding through gut-wrenching declines, through moments where selling seemed like the only sane option. Most people couldn't do it. Most people didn't do it. So what does this have to do with your $100,000 and the best 3 index funds? Everything. Just like those nifty 50 investors thought they were diversified by owning 50 stocks, you might think you're diversified by owning 3 index funds. But the mechanics of modern index funds create concentration risks that aren't immediately obvious. And understanding these risks isn't about avoiding index funds. They're still probably the best tool available for most investors. It's about going into this with your eyes open, so when the inevitable storm comes, you don't panic and sell at the worst possible moment. Let me make this really concrete with an analogy that might hit closer to home. Imagine you own a restaurant. You've spent years building it up, and it's doing well. You have 30 items on your menu, everything from appetizers to desserts. On paper, you look diversified. 30 different revenue streams. If one dish falls out of fashion, no big deal, you've got 29 others. But then you look at your actual sales data, and you discover that 7 dishes generate 80% of your revenue. Your signature burger, that one pasta dish everyone orders. The appetizer that's all over Instagram. Technically, you have diversity. Practically, you're completely dependent on a handful of items. Now, imagine food trends shift. That Instagram appetizer falls out of fashion, a competing restaurant starts doing better burgers, suddenly 80% of your revenue is under threat. But you still have rent, you still have staff, you still have inventory costs for all 30 items. You're not just less profitable, you're potentially bankrupt. This is exactly what happens in index funds, and most people have no idea. Take the S&P 500. It sounds diversified. 500 companies. That's a lot, right? But here's the reality. As of the time I'm making this video, the top 10 stocks in the S&P 500 make up roughly 35% of the entire index's value. Just 10 companies out of 500, the top 7, often called the Magnificent 7, make up even more when you factor in their influence on market movements. So when you buy an S&P 500 index fund with your $100,000, you're not really buying 500 equal positions. You're buying a portfolio that's heavily tilted toward Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla. And if those companies stumble, like the nifty 50 did, your diversified portfolio becomes a lot less diversified in a hurry. Now you might be thinking, but Tom, those companies are massive and profitable and dominant. They're not going anywhere. And you're right. They probably aren't going anywhere. But neither was Polaroid in 1972. Neither was Kodak. Neither was General Electric, which was the most valuable company in the world in 2000%, and at one point made up nearly 4% of the S&P 500 all by itself. Today, GE has been broken up into 3 separate companies and hasn't been a market leader in over a decade. This is where we need to talk about who benefits from you not understanding these concentration dynamics. The financial industry has a very specific interest in keeping you slightly confused, not completely lost, because then you'd seek help or give up entirely. But just confused enough that you feel like you need their products, their services, their guidance. This isn't a conspiracy theory. It's just basic business incentives. Index fund providers benefit when you pour money into their products without thinking too hard about what you're actually buying. They charge fees based on assets under management. The more money that flows in, the more they earn. So there's zero incentive for them to explain to you that their total market index fund is actually a tech-heavy, concentrated bet. That information might make you pause, might make you think, might make you diversify across providers or asset classes in ways that reduce their fee income. Financial advisors who recommend index funds as the default solution benefit from simplicity. If they can say, just buy 3 index funds and hold forever, they've given you a complete answer that requires no follow-up, no monitoring, no ongoing advice. They look smart, you feel confident, and nobody has to do any hard work. Until the market drops 40% and you panic sell because you never actually understood what you owned. Here's how they hide this stuff. First, they use the language of diversification constantly. You'll hear phrases like broad market exposure and hundreds of stocks and the entire economy. All technically true, all deeply misleading about the actual concentration within these products. Second, they focus on long-term averages. Yes, the stock market has returned roughly 10% annually over the last century. But that average includes decades-long stretches where returns were flat or negative. If you invested in the S&P 500 in 2000, it took you 13 years just to break even. 13 years of going nowhere while you watched colleagues buy houses and take vacations and you wondered if you'd made a terrible mistake. Third, they never talk about sequence of returns risk. This is the idea that when you get your returns matters as much as what returns you get. If you invest $100,000 and the market drops 30% in year 1, then recovers in years 2 through 5, you end up in a very different place than if the market rises for 4 years and drops in year 5. Same average return, completely different outcome. And this risk is particularly brutal for anyone in the first decade of their investing journey, which probably includes many of you watching this. But here's the reframe. None of this is meant to scare you out of index funds. That would be throwing out the baby with the bathwater. Index funds are still the most cost-effective, tax-efficient, and historically reliable way for most people to build wealth. The point is to transform you from a passive participant in a system you don't understand into an informed player who knows exactly what game they're playing. When you know that your S&P 500 fund is really a bet on big tech, you can consciously decide if that's the bet you want to make. When you understand that diversification across 3 index funds might not be as diverse as you think, you can add genuinely different assets like international stocks, bonds, real estate, or commodities. When you grasp that sequence of returns, risk can devastate your early investing years. You can maintain a larger cash buffer or take a more defensive position until you've built up enough of a cushion. Knowledge doesn't mean avoiding the system. It means understanding the system well enough to make it work for you instead of against you. So let's get into the actual math of what happens when you invest $100,000 across the 3 best index funds. And I'm going to be specific here because vague hand-waving about long-term returns helps nobody. For our purposes, I'm going to use 3 funds that represent what most financial experts would consider a well-rounded portfolio. First, a total US stock market index fund. Second, an international developed markets index fund. Third, a total bond market index fund. The specific tickers don't matter as much as what they represent, because all the major providers offer essentially identical products with nearly identical fees. Let's say you allocate your $100,000 using the classic 60-40 split, but with a twist for age-appropriate risk. $60,000 in the US stock market fund, $20,000 in international stocks, and $20,000 in bonds. This gives you exposure to about 4,000 US companies, 7,000 international companies, and thousands of individual bonds. On paper, you're incredibly diversified. Now, you might be thinking, this sounds pretty reasonable, and it is. This is essentially what every target date retirement fund does, what every robo-advisor recommends, what every personal finance book suggests. There's nothing wrong with this allocation. It's smart, it's boring, and boring in investing usually means effective. But let's look at the numbers over different time horizons. And I'm going to show you something that might change how you think about this. Over the last 30 years, the US stock market has returned approximately 10.3% annually. International stocks have returned about 5.6%. Bonds have returned about 4.7%. These are nominal returns before adjusting for inflation. Using our 60-20-20 allocation, your blended expected return is roughly 7.9% per year. That sounds great until you remember that inflation averages about 3% annually, so your real return is closer to 4.9%. Now let's compound this forward. Your $100,000 growing at 7.9% annually becomes roughly $215,000 after 10 years. After 20 years, it's approximately $463,000. After 30 years, you're looking at about $998,000, just under $1 million. This is where it gets really interesting. That sounds amazing, right? You turned 100,000 into nearly $1 million just by sitting there. Compound interest really is the eighth wonder of the world. But let's adjust for inflation using that 3% average. In today's dollars, your $215,000 after 10 years is only worth about $160,000. Your $463,000 after 20 years is only worth about $255,000. And your $998,000 after 30 years, in real purchasing power, it's approximately $412,000. Still a fantastic return. You quadrupled your money in real terms. But probably not the almost a millionaire fantasy you were imagining when I first said those numbers. This is the psychological trap that catches most people. They see nominal returns and think in nominal terms. They imagine what $1 million would buy them today, not what it will buy them in 30 years. And when their account finally hits that magical number, they're often disappointed to discover that it doesn't feel nearly as rich as they expected. Now you're asking yourself, okay, Tom, so what should I actually do? How do I think about this correctly? Here's the first action step, and it's something most people never bother to do, even though it takes about 15 minutes. Go into your index fund accounts right now and look at the actual holdings. Not the fund description, not the marketing materials, but the actual list of companies and their weightings. Every major fund provider makes this information available if you dig for it. When you see that Apple makes up 7% of your total US stock market fund, and Microsoft is another 6%, and Nvidia is 5%, you start to understand what you're actually betting on. When you see that the top 50 holdings make up roughly 50% of the entire fund, you realize that half your money is riding on the performance of companies that would fit in a small conference room. This isn't to suggest you should panic or change anything. It's to make sure you understand what you own. Because when, not if, the market drops 30 or 40% and your account shows you've lost $30,000 or $40,000 of your original $100,000, you need to know whether that's because the entire economy is struggling or because a handful of tech giants stumbled. That knowledge is the difference between holding firm through the storm and panic selling at exactly the wrong moment. The second thing I want you to understand is something called behavioral alpha. This is a fancy term for the extra returns you can generate simply by not being an idiot with your own money. Studies consistently show that the average investor dramatically underperforms the very funds they invest in. The funds themselves might return 8% annually, but the investors in those funds only get 5 or 6%. Why? Because people buy high and sell low. They get excited when markets are soaring and pile in at the top. They get terrified when markets crash and sell at the bottom. This behavioral gap is worth 2 to 3% annually. Over 30 years, that compounds into an enormous difference in final wealth. If your fund returns 8%, but you only capture 5% because of poor timing decisions, your $100,000 becomes $432,000 instead of $1,600,000. You literally left over $1 million on the table by being human. The good news is that this behavioral alpha is entirely within your control. You don't need to pick better stocks. You don't need to time the market. You don't need any special skill or knowledge. You just need to set up automatic investments and then never, ever touch them during drawdowns. This sounds simple. It is not. When you open your account and see that you've lost $25,000 of your original investment, every instinct in your body will scream at you to sell, to stop the bleeding, to get out before it gets worse. Your brain evolved to run from danger, and losing money feels exactly like danger. The investors who build real wealth are the ones who can override that instinct. And the best way to override it is to understand intellectually and emotionally that drawdowns are not just normal, but necessary. Markets don't go up in a straight line. They zig and zag. The price of long-term gains is short-term volatility. If you can't accept that trade, you should be in treasury bills or cash, not index funds. Now let's talk about something that almost nobody discusses when they're recommending index funds, which is what I call the accumulation illusion. When you're in the accumulation phase of your investing life, adding new money regularly, market crashes are actually good for you. If the market drops 30% and you keep buying, you're purchasing shares at a discount. Those discounted shares will eventually recover and generate outsized returns. A crash in year 3 of a 30-year investing career is a gift, even though it doesn't feel like one at the time. But here's where people go wrong. They assume that because crashes are good during accumulation, they should want volatility. They start seeking out higher risk investments, concentrated positions, leveraged products. They think if a little volatility is good, a lot must be better. This is catastrophically wrong, and it's why so many people blow up their portfolios chasing returns. The math is brutal. If you lose 50% of your portfolio, you need to gain 100% just to get back to even. If you lose 75%, you need to gain 300%. The asymmetry is devastating. Losses matter more than gains. Avoiding catastrophic downside is far more important than capturing maximum upside. This is why broad index funds, with all their limitations and concentration issues, are still superior to most alternatives. They can't go to zero. Individual companies can and do go bankrupt. Sectors can and do collapse entirely. But the entire US stock market? The probability of it going to zero is essentially the probability of civilization ending, at which point your portfolio is the least of your concerns. So when you allocate your 100,000 across 3 index funds, you're not trying to maximize returns. You're trying to maximize the probability of a good outcome while minimizing the probability of catastrophe. That's a fundamentally different optimization problem than most people realize. Let me give you a third piece of wisdom that took me years to understand. The most important financial decision you'll make isn't how you invest your 100,000, it's how long you can leave it invested. Time is the variable that matters more than asset allocation, more than fund selection, more than market timing. If you can extend your time horizon by even 5 years, you can afford to be more aggressive with your investments, weather more volatility, and capture more of the long-term premium that equities offer. Conversely, if you need the money in 5 years for a down payment or a business or a child's education, you shouldn't have it in index funds at all. The probability of a significant drawdown over any 5-year period is high enough that you could find yourself forced to sell at exactly the wrong moment. This is why I always recommend that people mentally segment their money. There's the money you need in the next 3 years. That goes in cash or very short-term bonds. There's the money you need in 3 to 10 years. That might go in a conservative mix of stocks and bonds. And then there's the money you're investing for retirement 30 years away. That can go into aggressive equity index funds because you have the luxury of time. Most people mix all their money together and end up with an allocation that's too aggressive for their short-term needs and too conservative for their long-term potential. They get the worst of both worlds. Now, I want to address something that might be buzzing in the back of your mind. What about international diversification? Is it actually worth it? This is genuinely one of the most debated topics in investing, and smart people disagree. The argument for international is straightforward. You're reducing your dependence on any single country's economy. If the US enters a prolonged slump, like Japan did starting in 1990, you'll be glad you had exposure elsewhere. The argument against is also compelling. The US represents about 60% of global stock market capitalization. Many of the largest US companies, like Apple and Microsoft and Google, derive huge portions of their revenue from international markets. So even if you own only US stocks, You're getting international exposure through those companies' operations. Over the last 15 years, US stocks have dramatically outperformed international developed markets. Someone who went all in on US stocks would be significantly wealthier today than someone who diversified internationally. This has led many investors to question whether international diversification is worth the drag on returns. Here's my take, and you might disagree. The last 15 years of US dominance is partially explained by the rise of big tech, which is a very American phenomenon. That outperformance is already priced into current valuations. US stocks are expensive by historical standards, while international stocks are relatively cheap. Buying expensive assets and avoiding cheap ones is usually the wrong move over long time horizons. The international allocation might drag on your returns for another decade and then suddenly outperform for the following 2 decades. You just don't know. And not knowing is exactly why you diversify. So I maintain the recommendation for some international exposure, even if it's a smaller allocation than US stocks. You're not diversifying for the expected outcome, you're diversifying for the unexpected one. Now, let's get into the psychological dimension of watching your $100,000 grow. Because nobody talks about this, and it's arguably more important than the math. Year 1 through year 5 are the hardest. Your balance is still relatively small compared to your future potential. Market moves feel enormous in percentage terms. A 10% drop means losing $10,000. That's a lot of money by any standard. It's a vacation, it's a car repair fund, it's 3 months of groceries. Watching it evaporate in a few weeks is genuinely painful. During this phase, many people capitulate. They convince themselves that investing isn't for them, that the system is rigged, that they should pay off debt instead, or save in a bank account, or try active trading. They exit right when they should be doubling down. If you can survive years 1 through 5 with your allocation intact, years 5 through 15 become progressively easier. Your balance is larger. So even though the percentage drops are the same, the absolute dollar amounts feel less catastrophic relative to your growing wealth. A 10% drop on $500,000 is $50,000, but you've already seen your portfolio recover from multiple drops. So you know in your bones, not just intellectually, that this too shall pass. Years 15 through 30 are almost enjoyable. You've built a substantial asset. Compound interest has started to dominate your returns. You're earning more from investment gains than you ever saved from earned income. The anxiety fades and is replaced by something approaching confidence. But here's the trap of late-stage accumulation: complacency. When your portfolio has grown to $800,000 or $900,000, you might start making decisions you'd never have made with $100,000. Taking concentrated positions in hot stocks, using leverage to accelerate gains, taking money out for lifestyle purchases because you feel rich. More portfolios are destroyed in the late accumulation phase than in the early years. Early, people exit out of fear. Late, they blow up out of overconfidence. The behavioral challenges evolve. They don't disappear. This is why having a written investment policy statement matters so much. Something you create when you're calm and rational that dictates your behavior when you're emotional and irrational. Your policy might say you never hold more than 5% of your portfolio in any individual stock, that you rebalance annually regardless of market conditions, that you never take money out before age 60 except for emergencies defined specifically in advance. These constraints feel restrictive when you're writing them. They feel like lifesavers when markets are crashing or soaring and your emotions are screaming at you to do something, anything, different from your plan. Let me share one more concept that transformed how I think about investing. It's called enough. When you invest $100,000, you're implicitly deciding what enough means to you. If that $100,000 grows to $300,000 in 10 years, will you be satisfied? What about $500,000, $700,000, $1 million? Most people never answer this question explicitly. They just want more. And the problem with wanting more is that more never arrives. When your portfolio hits $300,000, you'll want $500,000. When it hits $500,000, you'll want $1 million. When it hits $1 million, you'll want $2 million. This hedonic treadmill applies to investing just like it applies to income or possessions, and it leads to genuinely destructive behavior, taking unnecessary risks to accelerate gains, never reducing risk as you approach your goals, working longer than you need to because your number keeps moving. Defining enough in advance, putting an actual number on it, is one of the most powerful psychological moves you can make. It might be $2 million, which at a 4% withdrawal rate would generate $80,000 annually in perpetuity. It might be 1.5 million. It might be 3 million. The number doesn't matter as much as having a number. When your portfolio approaches that number, you can begin shifting toward more conservative investments. You can start thinking about withdrawal strategies instead of accumulation strategies. You can mentally prepare for the transition from building wealth to using wealth. And crucially, you can feel satisfied when you arrive, instead of immediately moving the goalposts and wondering why you never feel rich enough. Let me bring this back to where we started. Those Florida land speculators in 1929 thought they were building wealth. They were just shuffling paper. The nifty 50 investors in 1972 thought they were being conservative and smart. They were actually taking concentrated risks they didn't understand. In both cases, the people who got hurt weren't stupid or greedy. They were just operating without a complete picture of what they were actually doing with their money. You don't have to make the same mistakes. When you invest $100,000 in 3 index funds, you can do it with full awareness of the concentration risks, the behavioral challenges, the psychological traps, and the timeline realities. That awareness won't guarantee better returns, but it will dramatically increase your probability of staying the course when everything feels like it's falling apart. And staying the course, showing up with automatic investments month after month, year after year, decade after decade, not panicking during crashes, not getting greedy during bubbles, that's the real secret. It's not a secret, really. It's just hard. Hard in a way that no spreadsheet can capture and no calculator can model. The people who build serious wealth through index funds aren't smarter than you. They aren't luckier. They just understand that the game rewards patience and punishes activity. They understand that doing nothing is often the best possible strategy. They understand that the goal isn't to maximize returns, but to maximize the probability of a good enough outcome. Your $100,000 invested across 3 solid index funds, left alone for 30 years, will almost certainly grow into something substantial. Not because you're a genius, not because you picked the perfect funds at the perfect time, but because you understood the game well enough to keep playing it when everyone else quit. That's the edge. That's the alpha. That's what separates the people who actually become wealthy from the people